Hi guys, this will be a short video explaining the trade idea based on uh, the logic that I used yesterday for my trade. Okay, I was looking for higher prices here. I was looking for this new month opening gap as a draw liquidity here. I don't have it here in this chart because this is the actual contract and this is the continuous contract from the daily chart, so it's not the same gap. So I have the new week opening gaps for my short term from the current contract, and these ones are from the previous, sorry, for the continuous chart. So you can see how I have two lines here between the actual new week opening gap and the previous week. So from the actual open to the previous gap in close proximity, we have the 50% that has the P letter and refers to the previous event horizon from the previous week. And in close proximity from this gap to this one, we have also this event horizon that it was aligned with the new month opening gaps here. You can see it very just perfect align the event horizon and the new month opening gap. Okay, so this was my draw liquidity for today after we had a daily S&T at the lows with Nasdaq, ES, and Dow. Okay, then what I was expecting in order to go higher, I want to see if price can reach some kind of discount array from the previous RTH range. Okay, so you can see here is that those candles are the regular trading hours. So we gap inside, this is the regular trading hours high and this is the low. So from here I want to see if we have an inefficiency near the equilibrium or our order lock, and we have both here. We have this order lock, 15 minutes order lock, and this imbalance right here. So this, even if we reach this order lock outside of my regular trading hours, I wanted to see this array being traded inside of the RTH hours. This is a time-based delivery. I have a video in my YouTube explaining the logic of this approach. So for me, I was looking for this specific sell side that it's overnight from the sell side liquidity from overnight hours, and we tap into the regular trading hours array. This is an offset accumulation or order pairing inside of these levels, and then I was looking for my draw liquidity was this overnight highs, and finally the event horizon and 4 deviations from the regular trading hours gap. Okay, so this was the idea for the trade, and we were anticipating inside of the channel that the open is gonna be a little bit hard because we open inside of gaps, so a cluster of gaps. So price tends to be like referring to one another, but finally we leave the gap and we reach the level, this one that we were looking for. Look, for example, here the 4 to the 2.5 standard deviation, and then price come back and trade inside of the gap, the new week opening gap. So once the buy program has begun, we are using old gaps as a new areas for reaccumulation. Okay, so based on that, I took this trade. Once I see that we displaced through this short-term high here, we close above it with displacement. My entry was the order lock formed inside of the new week opening gap low here. Okay, so this was my entry. You can see the execution in my X account, and my target was the overnight highs. This was the trade. Was a really nice trade. So we look how we were basically creating like a balanced price range inside of the new week opening gap, and then price just went higher, and we even create another imbalance displacing through the consequent encroachment of the regular trading hours gap. This is another institutional order for entry drill. You don't want to see price once you see this signature of displacement through the most significant level of the gap, that is a consequent encroachment. You don't want to see price coming below. So if you are taking this institutional order for entry drill, you don't want to see price coming to the low of the gap basically. And you can use this as another opportunity to go long towards the overnight buy side here. And then we reach before the launch macro, we reach 4 deviations and the event horizon. So once we do that, now we have a retracement program. During the launch macro, we had an SMT at the highs, and then price start to moving lower to reaccumulate inside of the gap again. And then from the PM session, we had another continuation. So we had a New York AM reversal, PM launch retracement, PM continuation. That's the profile for today. So you can trade basically, if you can trade during the AM session, wait for a launch retracement or accumulation, and then the PM session, now it will be the continuation from the AM session. And you can see how we close basically at the event horizon from the gaps. Okay, so this is a really clean example, and this model, I call it like the Deceiver model. What we does is basically we rebalance the gap that we have, we rebalance the gap, and then we reverse towards the opposite side. Okay, so this is the Deceiver model. It's really simple. We deceive people, then accumulate and distribute higher. But it's not like a Judas, like simple, like you take the liquidity and then move to the, no, you have like this two stage delivery from the gap, rebalancing and then reversing to the opposite side. Okay, so I will do this for every trade that I take, explaining the logic for this, in order to help you to understand the logic using gaps and how to frame trade ideas using the regular trading hours gap and the other gaps that I use. Okay, stay safe.